And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
Good morning. Welcome to The Real Investment Show. I'm Danny Ratliff here with John Penn. Sorry, guys. Know y'all were expecting Lance today, but no can do. So, good day yesterday. Actually broke the trend of a bad market for a minute at least. 400 of the 500 S&P 500 constituents were actually positive. A little bit of a sector rotation going on. Energy kind of leading the way. Financials did well yesterday. Materials was the worst sector. Market down 3% last week, the S&P, 4.6% decline in all. Man, feels like a little bit worse. I think that, haven't been accustomed to this type of volatility in a minute, John.
Yeah, it feels worse than what it really is. I had a client reach out to me. It's like, hey, the markets are in free fall. I'm like, wait a minute. Free fall? The market was down about 1.3% at the time. That's, to me, that doesn't sound like free fall to me, but it just shows you how kind of the hype around the market, just the financial media, they're kind of all over it. And again, it just kind of goes into that emotional feeling of, hey, the market pullback feels like it's worse than what it really is, right?
Yeah, I think that it's been more of a technical kind of decline than a fundamental. Not a whole lot has technically changed here in some ways, right? Mm-hmm. And so this was something where it's an oversold market. We did expect that. Futures are up a bit. We have seen, obviously, CPI has been a little bit higher than expectations. PCE, though, the big indicator that the Fed watches, has been the weaker of the CPI, PPI type of conversation. And so that comes out Friday. And I think everybody's really waiting on that. Now, clearly, the market has gotten this wrong as far as how many rate cuts they've expected for this year. And that's going to be still something that we're going to have to continue to watch because things can change quickly. Now, any of these revisions that we've historically seen, a lot of times are revising them downward. That just hasn't been the case so far, especially when we look at retail sales, all the other things that have done well. But this is one of those issues where we talk about soft landing, no landing, a hard landing. Right now, we're kind of out there in the middle of no man's land because I'm not sure that anybody has a whole lot of direction one way or the other. But, fiscal policy has been what has pushed this up. And so quality in picking stocks, I think, is going to be extremely important moving forward. And, it's not going to be as easy as what it once was the later in the game that we get here. And so keeping our eyes peeled on this and kind of really understanding. Now, is there more decline in, here? Possible. We've been expecting, Lance has been talking about, we have this oversold bounce we should expect. If you're looking to trim up maybe your portfolio a tad bit, trim some positions, take some gains. This could be a great opportunity to do so. Market futures are pointing up slightly here as of right now. I know there's been a lot of concerns with rates creeping up higher as well. That's one of those things that we've kind of talked about that we think is going to still bounce around quite a bit here as the market tries to decide in the economy which direction we're going. But inevitably, we do believe that rates are going to fall. Now, could be wrong. And we're going to talk a little bit about, what is the path forward for 5%? Can we get there? I know, John, you told me earlier you've been getting a ton of questions on fixed income.
Yeah.
And I think that it's natural. Anytime that we see yields pop like this, and if you're holding bonds, it's not good. Not good momentarily for that net asset value.
Yeah, especially if you're holding longer duration bonds, which we do have an allocation to that within our overall strategy. It's just as rates kind of tick up here a little bit, you see a little bit of that red on your screen as your bond prices pull down, and it's like, oh, hold on a second. Then all of a sudden, rates kind of tick back a little bit, and you see those bond prices recover, and it's like back and forth, like the pendulum, one side to the other. I made Brent laugh a little bit there. See that? But just again, rates have kind of ticked up here on the 10-year, a little over 4.6. I think it's around 4.62% this morning. Like Danny mentioned, we do think that rates are going to come down eventually. It's just, that decline may not happen in a straight line. Things are going to bounce around here a little bit. So we've seen a little bit of an uptick here in the near future, but we'll keep an eye on it, but nothing that we're really concerned about.
Yeah, so aside of PCE this week, we do have 150 companies out of the S&P 500 reporting earnings. So big news there. We're going to get into a couple things. Last week, Lance and I tried to get into 12 ways to screw up your retirement savings and didn't quite get through the end of it. But we did have a lot of questions surrounding that on, hey, what about if I'm already retired? Because a lot of this was based on a little bit of both. You could be, in either stage, getting up still be an accumulator or in that distribution mode. And that is what it's so difficult for many people, John, is to really find their way through and say, cross over from an accumulator to a decumulator. It's so difficult. We call it the crossover risk or the black hole because, we don't get a whole lot of practice time for that. It's usually we flip a switch and boom, we have to be right there and ready to go. And then you found an article, Retiring in the Next 5 Years, Avoid These Financial Mistakes. I think we'll be able to throw those two together. Did have a can of coffee this last weekend. Brent has been so kind as to cut that up and take some of the excerpts out of that. You'll be able to find that on the Real Investment Show or realinvestmentadvice.com. Go to the Real Investment Show YouTube channel. Go hit like, subscribe. We appreciate you guys there. Going to get into quite a bit more information. But, a couple other big things we want to get into. Heirs get more time to keep their money in inherited IRA accounts. So, John, real quick before the break, what does that mean?
Well, so with inherited IRAs, especially for non-spouse beneficiaries, there's been a change to the rules as far as when do those monies need to come out of those IRAs that you inherited. So basically, back before 2020, as a non-spouse beneficiary, if you inherited an IRA as a non-spouse beneficiary, Danny, you could potentially stretch those IRA distributions out over the course of your lifetime, right? Kind of stretch out those distributions, kind of help manage your taxes over time. Well, since 2020, late 2019 is when the Secure Act went into place. So then starting in 2020, the rules changed for non-spouse beneficiaries. So as a child, or as a non-spouse beneficiary, you can no longer stretch those inherited IRA distributions over time. Now there's a 10-year rule where that money needs to come out by the end of the 10th year following the account owner's death. Well, there's been a lot of confusion, to say the least. What happens years 1 through 9, right? So we'll get into a little bit of that here a little bit later too.
Yeah, so Iconoclast 2000, yes, we are watching, and I'm really impressed you're here longer than 5 minutes, so thank you for that. So managing my parents' retirement funds, how can you increase inheritance, right? I think there's a lot of different ways you could look at that. But the problem here is that Uncle Sam wants to keep more money from you, and essentially, we've been able to stretch these IRAs out over a longer period of time. And now the problem is that Secure Act and Secure Act 2.0, we have this 10-year window where effectively you have to take these required minimum distributions where you cannot stretch it over your lifetime. And so what they're trying to do is get their hands on the funds quicker, make you pay taxes sooner. And that's an issue. So some of the things that we do see a lot of people doing is depending on what tax bracket you're in, what tax bracket the parents are in, they may begin to think about, okay, if we have a legacy intent here for longer term planning, then maybe do you go ahead and do you start looking at Roth conversions? Do you go ahead and do that while they're in a lower tax bracket? We still have this current tax code until 2026, so effectively a 2-year time frame that you have the ability to go out and maybe pay a little bit less in taxes, keep more money in your pocket, because that is the name of the game. So we'll talk a little bit more about that on the way back. Thank you guys for joining us. Iconoclast, I appreciate you still being here, and we'll see you on the other side of this break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. I am Danny Ratliff here with John Penn. So, last segment, somebody brought up a really good point. How do you manage funds with legacy intent in mind? And hit on a couple notes, but, you know, we did promise we would get into, well, what should you do if you're retiring the next 5 years, or those 12 ways to screw up retirement savings? And we could talk for a long time on this. But I think, John, that goes hand in hand. And really what the intent is, or what's important, is the intent of funds. And you may have some funds that are more, you may be more inclined to use for legacy. You may have other funds that you may be more inclined for income, expenses, just meeting your needs. And I think it's really important. And, you know, we see a lot of good, bad, and ugly, and we do see a whole lot of good. But there are small, simple things that you can do, I think, that really increase your chance of being really successful in retirement. Mm-hmm. And one of them, and I know you guys are probably sick or tired of hearing this if you've watched the show for any period of time, is doing a financial plan. And so, you know, we talked to so many different people, and you hear from these people, John, and how many people you had that come to you and say, man, I've been wanting to talk to you guys for years, but I really just needed to wait until I got to retirement. And so, hey, I'm about to retire here this month. Can you help me? And yes, absolutely, we'd love to. But there could have been a whole lot of low-hanging fruit and things that we could have done in those years prior to retirement that really helped quite a bit. John, what do you see around that?
Yeah, I mean, sometimes, hey, absolutely. If you reach out to us and it's about 4 or 6 weeks away from, hey, that time where you're going to phase into the next chapter of your life, if that's retirement, we're happy to help you and talk you through with that. But to Danny's point, you know, most of the time it makes sense to start that planning process, you know, sooner rather than later, because there are things that you can be doing now to really increase your odds of having that successful retirement, or, you know, reaching that goal of what you want that to look like. So, and a lot of it, and I know, look, financial planning is part of, we're trying to predict the future a little bit, right? Mm-hmm. But at the same time, too, it's about putting what I like to call some realistic, forward-looking assumptions together. Let's get an idea of, okay, where are you now? Let's use the data inputs. What do we know right now, and what are some realistic expectations or some realistic forward-looking assumptions that we can put together to model out, hey, well, you know, what do you think your expenses will be? And it's not just your basic living expenses. You're talking about that family intent or that legacy intent. What if you want to leave money to a loved one or family or children? Or what if you have charitable, you know, inclinations? Let's build all of this in here to say, well, here's what I want to save for myself. Here's what I want to save for my expenses. Hey, but I want to set another set of money aside for charity or for family, whatever that may be. But in addition to all of that too, you know, what are the things that maybe you and your significant other, or, your loved one want to do for fun. Travel, hobbies, gardening, traveling across the world, whatever that might be. I mean, we got to put some ideas together on what we think that might cost, and are those realistic goals that we can achieve moving forward? And what this all really comes down to then, and it's so much more about just your expenses. What about your sources of income? Social Security planning goes into that too. That's huge, right? Or maybe you're lucky enough to have a pension or other sources of income, rental properties, whatever that might be. We got to look at all this together to figure out what's the right recipe for the timing of all of these various incoming cash flows to help support the next part of your life. And following the market, it's that's important too, and watching the markets and interest rates and all the things that we all talk about here on a regular basis. But at the end of the day, also through that planning process, what we really want to figure out, regardless of what the market does, regardless of what the Standard & Poor's 500 index does, regardless of what the NASDAQ does, what Bitcoin's doing, whatever the theme of the day is, what is the rate of return that you need? Right? What is that hurdle rate? What is the rate of return that you need to hit over time for all this to work? And what that really helps Danny and I and all of our colleagues here really figure out is, at the end of the day, just how much risk do you really need to take for all this to work?
Amen. I mean, right? You can't say that much better. And so, I think those are really, really good points, and how all these things are tied together. And, it's kind of weaving them in and out and understanding exactly how they work and when, and to not leave any money on the table. So we talked a bit about, keep more money in your pocket. That's a big part of this, from Uncle Sam, from protecting from markets, mitigating risk, participating, and then effectively understanding when you take Social Security. How do you maximize those retirement benefits? Understanding, if you do have that pension, can you take the pension? Mm-hmm. Should you go out and look on the secondary market and say, is there something better that lets me hold on to the assets and still get that same type of return, or create that paycheck essentially, or maybe even better? For years that's been completely off the table, and over the last year and a half, that's actually been something we can look at finally. So there's things out there that I think you can help kind of navigate and get a better understanding on. But another part of this, John, is that I see a lot of times somebody comes and they say, okay, I need X amount in expenses, in income, right? Mm-hmm. I have this much in expenses, I think. But they didn't go through and do the budget. And that's a big 4-letter word, right? Nobody likes to budget. Everybody, it's difficult. Nobody wants to be told. And one thing I've been told often, or several times, is that I don't want to do the budget or tell you what my expenses are, because I don't want you to tell me how much I can live on. It's like, whoa. You're telling us what you spend, and we're going to try to find, is that achievable?
Yeah.
How long can that last? I think that's the big part. We're your advocate. Any advisor should be your advocate. Bottom line, somebody who can say, you don't need a yes man. You need somebody who's going to get out there and say, this is a great idea, or this is a terrible idea. Mm-hmm. Or, you know what? I like this, but maybe there's a little bit different route we should go, or look at this a little bit differently. And so, sometimes when somebody comes with just big lump sum and they say, I need $100,000 in retirement. Okay, well, what are your basic necessities? Let's break this down. Do us and do yourself a favor and get a really good understanding. All right, my mortgage, my insurance, my taxes, clothes, fed. What do I need to keep a roof over my head? All the basics, necessities. And then let's go one step further and say, all right, we're going to travel. Where are you going? Are you taking a trip internationally every year, maybe 2? Are you paying for family to come? You want to go on a Disney cruise? I mean, what is it that you guys want to do? And I want you to put down the craziest ideas, the pipe dreams, the things that you're like, we'll never get there. And let's see if we can make that happen. How many times have you told somebody they can actually spend more money?
Well, that's the thing where it's like, hey, you look at the plan, you look at what the probability of success is, and maybe they're up in the high 90%. Right?
Yeah.
I mean, especially with the forward-looking returns that we use. So, and I know you've probably heard this if you've been listening to the show. From a forward-looking standpoint, it would be easy for Danny, Rich, all of us here to use, let's say, historical market return data for forward-looking returns. Well, we don't know if we're going to have market returns moving forward that we've already had in the past, right? So, should we plan when we build a financial plan, it would be easy for us to say, you know what? Hey, if you can just plan on your money compounding at 8 or 9 or 10% a year moving forward, guess what? Yeah, you got nothing to worry about. Well, what if the market environment doesn't give us that, right?
Yeah.
But even with some with some conservative forward-looking returns, a lot of the clients that we work with, we're very lucky that a lot of the clients that we work with are great stewards of their capital and they're great savers, and they do that budget, right?
That's right.
And it is not rare for me to say to somebody, hey, you know what? You can actually go spend a little bit more, right? It's okay. Take that trip, right?
And I find that a lot of people they're apprehensive to do so.
Yeah.
They're like, oh, I don't know. I don't think I can do that. And, that's probably why that's a big reason why you got into the situation that you did, because you lived beneath your means. You did a great job. You, like you mentioned, a good steward of capital. You understood, your human capital while you were working, putting these funds aside, and did a great job. But now you can reap those rewards.
Yeah.
And I think the benefit of that is huge. But, that's where getting into the nitty gritty of this and getting a very good understanding as far as what your expenses may be. We talk about the retirement smile and how, for many people, retirement looks different, right? Every household is different. Everybody has different needs, thoughts, wishes, wants. But where do we start to break this down? And there are some things that we see that are natural. They are going to happen over time. Travel, for instance, you may start checking off your bucket list items when you retire. You're going on bigger trips. As you age, that begins to stop. I mean, I've seen the progression of this over and over again, where somebody may be traveling internationally, and then it begins to be more domestic travel. Then it's more travel to see family, and it just slows down a little bit. I've had clients call and say, hey, I'm going to reduce our distributions because we're tired. We're not doing this anymore. It's just getting in and out of the airport or getting on the cruise ship or, just the little things like that where they begin to slow down. And so that's going to happen. But we can plan for that within your plan. Now, listen, the plan is not an end-all, be-all. We like to say that it's a living, breathing thing in the sense that it's not something that's designed to be shoved in a drawer, done once, and never looked at again. It's designed that life's going to happen. You're going to get a fork in the road. We're going to be able to go back to that because we have the foundation built and determine what is the best road for you to go on. Life's going to happen. Things are going to change. And this is going to be a great tool and a resource for somebody that we can go back towards. And so it's extremely important that, we have an idea. You have a very good understanding as far as what to do. And then we start to break all those expenses down to get that better understanding. Because the other caveat to that is while travel, vacation, some of these other things may slow down, the things that will pick up, healthcare. Mm-hmm. Those are things as we age, we're going to continue to see creep up there. And so the importance of building this and getting accurate information and getting data that, look, it's going to change over time. And, you mentioned even the forward-looking returns being less. Our job is to play devil's advocate, not to give you this rosy, here's best case scenario. Because I can tell you best case scenario, at the end of 2022, we had a lot of people call and say, hey, talk to my brother, talk to my sister, my coworker. Their plan doesn't work.
That's right.
8, 9, 10% returns every year. Not feasible. We'll be right back after this quick break.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Food in total is now making up 30% of the average discretionary income.
I believe it. I mean, that is our largest expense is food. And we rarely eat out.
The Real Investment Show podcast.
Our biggest frustration at home is how do we do this cheaper?
Yeah. No, I agree. We're running Hunger Games at our house.
At realinvestmentadvice.com.
So, if you can make it to the table without getting killed, you get to eat.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. I'm Danny Ratliff here with John Penn. Great chat going on in the YouTube channel.
Folks are fired up this morning.
Yeah.
I think the coffee is flowing.
You haven't been there, go to the Real Investment Show. Please subscribe. I'm going to get in a couple of these comments here in a bit. Some good questions. Maybe a mug or two. We shall see. So we talked a bit about the financial planning, the tools that we can use, and the things that we should look at. And John, I think you know, if I could take your snippet of the things you said there, and I would put that on repeat, because there's so many good words of wisdom that just in general, I think that we know. I think in general, we're not telling anybody anything you don't know, but it's difficult to take an inventory of it all, understand how it all works together, and then ensure that we do it all properly, and there's some cohesiveness to it. And that's difficult for a lot of people. Life happens fast. There's a lot of things that occur. But once we get that foundation done, it's relatively easy to the upkeep. Now, the caveat then begins to look at what happens when new legislation, new laws, taxes change. Just like you mentioned a bit ago, the Secure Act 2.0 changed how you have to take required minimum distributions. RMDs in general. So RMDs, when you reach 70, it used to be 70 and a half, you would have to start taking distributions out of your pre-tax accounts, IRAs, 401ks, and they changed that to 72. Then they changed it to 73. In about 9 years, it goes up to 75.
75.
For whatever reason, they decided that we need this big break. But those are things that we keep up with. So what are some of the things, though, John, like, that you see as if you're talking to somebody who is 5 years out from retirement, what's something they need to know and need to do now?
Well, I think, excuse me, I think some of it is, making sure that, a couple things, what are you saving? What amount are you putting aside every year to kind of reach those goals, right? And so maybe you kind of, there are some opportunities that maybe you don't take advantage of, which is, let's say, maximizing how much are you putting into your 401k plan or your 403b plan or a 457 plan, just that retirement plan that you have, let's say, through your employer. Or if you're self-employed, what if you don't have an employer-sponsored plan? Explore options like maybe a SEP IRA or something that allows you to put money aside towards your retirement. But now, and I know you and Rich talk a lot about Roth, right? Well, not so. Even if you're contributing to your employer-sponsored plan, does it make sense if you have a Roth option to start turning on that Roth faucet, maybe start turning off the faucet on the pre-tax? I know it hurts to maybe pay a little bit of money now. I know that money, you're paying the tax now, that money's going in after tax, but that could be a huge benefit for you when you do get into those later years and when you do get into that next chapter of your life where you have access to funds that you can pull from to help supplement your income. And now that money's tax-free, right?
Yeah. And that's huge because that tax-free income that you are going to want to pull from at some point in retirement, especially if we continue to spend as a nation the way we are, I assume we're going to see higher taxes. Not to mention if this tax code just sunsets in general, we know this tax code is going to change. So having that ability in a Roth or another account that's going to give you that flexibility is huge. You have a tremendous asset now that you can withdraw from tax-free, which doesn't affect that Social Security taxation.
Right.
Which doesn't impact Medicare premiums. I mean, all these little things, and I do suspect that these will change as well. We call those back pocket taxes, that at some point those will likely go up. I mean, I think people are fearful of means testing. We already have that. If you make between 32 and 44,000, you're going to have 50% of your Social Security benefits taxable. If you make more than that 44,000, 85% of it is taxable.
That's right.
Now, a lot of people are going to fall in that, right? If you're under that, let's face it, you're under the poverty level, under that poverty line. Now, on the other side of that, we also have the IRMA charges for Medicare. So having those funds in an account that gives you flexibility is crucial. I mean, we talk about this all the time, that we see a lot of people, and you may be one of them, and that's okay because we've been taught for years, pre-tax, get as much as you can in that account. You're going to retire in a lower tax bracket. But the problem is that many people, the majority of their wealth outside of maybe their home is in that pre-tax 401k account. And then we want to do those things like we talked about a bit ago. You want to check off the bucket list. You're spending a little bit more. All those other little things start to go up with it. So you're already being means tested. Now, you also see sometimes, based on how the company matches the 401k, that maybe you're not fully taking advantage of it. And that happens a lot, especially if you may have we're going to match up to this, but we're going to give an extra $500 every month that you put in X amount. And sometimes I've seen this too, where somebody has gone and they have actually, they think they're doing the right thing. They max out the 401k early. So 2024, if you're over 50, that's $30,500. But they maxed it out early, like, this is great. But we went back and said, well, they're giving you an extra $500 that you put in at least X amount each month. So if you max out in the first 2 months, and I know that's not everybody can't do that, right? But fantastic to be able to do so. You start thinking about it and you say, whoa, there's $5,000 I just left on the table that you could have received. So in that instance, we had to go back and say, okay, for the following year, here's what you're going to do. We're going to put in X amount, this percentage of your income, so that you get that extra $500 every single year. Now, this is a unique plan. It wasn't, we don't see that every day, but I do see those from time to time. So really getting a very good understanding as far as what your match looks like, how they match it, are there any other incentives associated with that, I think is crucial.
Yeah, and something else that I see too, and we get a lot of questions around this, is, well, hey, I'm maxing up my 401k plan, or I'm maxing out my 403b, so I'm not able to make a contribution to my IRA because I already maxed out my contributions for the year. Got to take a step back. The contribution limits to an IRA and the contributions that you can put into a 401k, 403b, 457 plan, those are separate silos, right? What you do over here in your IRA, the contribution amount that you put in your IRA isn't going to affect the contribution amount that you put in your 401k plan. That's in addition to, right? And something else too that, sometimes that I see a lot of this too, Danny, is with a working couple, let's say husband and wife. They file a joint tax return. Let's say one of the individuals is the wage earner, and maybe the other spouse is the one who's running the family, running the household. Maybe they don't have quote unquote earned income. Well, the working spouse that has earned income, in addition to making a contribution to their traditional IRA, or if they qualify for the Roth IRA, they can also make what is called a spousal contribution to their spouse that doesn't have earned income. Right?
Correct.
So you can make a spousal contribution. And a lot of times that gets overlooked too, right? So just little things that can help add up over time.
That's right. And so many people overlook that. That's just this one small instance. The other thing that you see a lot of, I bet, John, is that, because I know I do, is the Roth 401k. Somebody's saying, well, I really want to put funds in a Roth IRA or Roth 401k, but I make too much money.
Yeah.
And so the Roth IRA, there are income limitations. But on the Roth 401k, there are none. So you could put funds aside. Now, maybe you may be in a really high tax bracket and you don't want to put the funds. I get it. But I'd start hedging those bets and do a little bit in each. So keep that in mind when we're talking about the Roth 401k. We don't have to worry about the income limitations.
That's right.
So you can put those funds aside into that type of account. And no, you don't typically retire, and it's much less of a tax bracket. I mean, we hear that. We've been told that forever. And I think that was the whole pre-tax mantra, right? Mm-hmm. No, put the funds aside here in the pre-tax. And, I like to kind of think that maybe it's a conspiracy theory, maybe not. But, these companies are incentivized because they'd rather you fully fund those accounts because they're paid off of assets versus you paying taxes and putting a little bit less maybe, which we've got to think about what's going to be most suitable for you.
That's right.
What does that look like from a distribution? What does that phase look like in your life, and how do we continue to keep those funds and make them last longer? So it gives you a lot more flexibility. But how many times do you hear somebody so getting close to retirement or at retirement? I mean, we've had people call and they're like, "Hey, I retired yesterday. What do we do now?" Or just took Social Security.
Yeah.
I mean, there's a lot of moving parts with Social Security that I think that we probably take for granted a little bit in a lot of ways. And Social Security for many people is it's confusing, or it's just, a lot or emotional because we hear the numbers. Social Security is going away, or it's going to run out of money in 2033. It's not going away, but there's a 20% in benefits that'll be reduced if they don't do anything. And we've gone over the numbers on how many people rely on Social Security for more than half of their retirement income, a quarter or more than 90% of their retirement income. A quarter of the people need it for that. So Social Security or something like it will be here. It's going to have to be. If not, we're all in big trouble.
There'll be a riot in the streets.
Yeah, it's not good.
Yeah.
So what would you say, earliest you could take Social Security, 62. Mm-hmm. What would you say to somebody who retires and says, hey, I'm getting all I can out of it right now? Or maybe they're not retiring, they're just 62.
Yeah, I mean, there's so many things you have to look at. And we'll talk about this more after the break, but life expectancy. What are your income needs? What if you're married? What's the life expectancy of your spouse, right? How does that affect when you take your Social Security benefit, right?
Yeah,
it's not just about you. Mm-hmm.
Not all about you guys. Hey, we'll be right back. We'll pick this right back up on the other side of the break.
Daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Like I'm at home, Brent. I'm kidding. Michelle, I'm kidding.
Here's the important part of the lyric. It's all about you, baby.
I dig it.
Not bad. Hey, welcome back, guys. So talk a little bit about things we can do in as we get near retirement and what we should be doing, thinking about Social Security, making sure we don't make emotional decisions. And so Social Security is one that we tend to see as extremely emotional. We put money in, everybody feels one way or another about it. I know how most of you do. And, one thing about Social Security, though, this is a lifetime income. This is something that is nice to have, and we want to make sure that you do it properly. So we do see people who are still working or still have income coming in that take Social Security early. And most of the time it's based on, well, my friend, we talked to them about it and they said, they gave me all these reasons. Social Security is going out of business. We need to get all we can out of it. But what if it doesn't? And like I said earlier, I don't think it's going away. I think that there will need to be major reform. It's not electable, so our politicians kick the can down the road, but it is something that will need to be addressed. It'll likely be in the in a dark room at the last hour, and it'll get done and be announced at like 2 a.m. so nobody hears about it. But somebody who takes it early, we could be forfeiting or leaving benefits on the table. If you're married, as John, you mentioned earlier, you need to think about the longevity of not only you, but your spouse. And why is that so important?
Well, it all comes back to what we were talking about earlier too, which is that viability and looking at that that longer term financial plan, right? But let's just say, there's so many things to consider when it comes to looking at the recipe or the timing. When's the right time to take your Social Security? But a big piece of that is what is the income stream that will be there for the surviving spouse, right? So, and usually it's the ladies that outlive us men, right? So wanting to make sure, hey, when I take my Social Security, when I take my benefit, Danny, if I predecease my wife, Shauna, I want to make sure that I'm leaving her in the best financial situation that I possibly can, right?
Yeah.
And so that is, so maybe, you know, and I've seen this happen sometimes too with spouses. Maybe the spouse that has, maybe they haven't earned quite as much income over their lifetime. Okay, maybe they take their benefit a little bit early. You have some income coming in now, right? It's kind of a hybrid strategy. So of the couple, maybe one of those, maybe one spouse takes their Social Security benefit a little bit early, right? You have some money coming in now, but then the higher earning spouse that has the larger benefit, they delay. Maybe they delay and can take their benefit at age 70, right? So you get a little money now, but then you're maximizing the other spouse's benefit later. Well, then that max benefit, assuming that let's say the higher income earner or that higher paying spouse, let's say it's the husband in this example, if the husband predeceases their wife, well, then now all of a sudden the wife, her benefit is going to step up to the larger survivor benefit, right? So you just have to kind of think around the timing. I'm not saying that's right for everybody. Everybody's situation is different, but there are some things to think about because we can run different Social Security, recipes to see, okay, well, what makes the most sense, right? From a timing standpoint.
Yeah, and so I think that you need to remember that this is different for everybody.
Right.
Just like as we mentioned, and there's going to be a time that maybe you have to take. You've been laid off. You need the income. Your life expectancy doesn't look that great. Maybe you need to go ahead and take that. But we also want to be mindful of our spouse if we're married and what is most beneficial towards them. The other caveat I do see is I see somebody that retires early. They go ahead and take Social Security at 62, but they have deferred comp. They have other earned income that's coming in, or maybe they don't retire at all, but they're still working.
Yeah,
or their spouse is working. They take Social Security, and so something that catches a lot of people by surprise is that if you make more than $22,320 in 2024, for every $2 over that, you're going to have a $1 in benefits withheld, meaning that if you're still collecting, you may collect that whole year and then Social Security finds out, whoa, you had some income come in. And over that amount, you will have to pay and write a hefty check to Social Security.
That's right.
And then they typically stop benefits. You have these benefits withheld. And you've locked in a reduced amount. Now, that number goes all the way to $59,520, where for every $3 over that, you essentially have $1 withheld. So the main thing that we want you to realize is that there could be a pretty big surprise if you're still working and you're taking Social Security. So make sure that you incorporate this within your overall planning when you're going to retire, because this is one you don't want to have happen.
That's right.
And we do find that there are break-even points. So depending on your health, your longevity of you and your spouse, this could be something where it does pay to delay if you can do so. Not everybody has that luxury. But if you do, this is where some more sophisticated planning, maybe like you mentioned, John, where one goes ahead and turns on their benefit, the other spouse continues to let theirs grow, maybe the high income earner, and then they turn that spousal benefit on for the spouse who already started taking off their own benefits if they have those 40 quarters or 10 years. So Social Security, analyzing, understanding, so crucial. Want to get into a couple other points, but we did have a good question. So where was the income line for Roth conversion? Go ahead, John.
No, I was going to say, I mean, this is probably not the answer you want to hear, at least not from me, but it's going to be different for everybody.
Yeah.
In my mind. I mean, it's, everybody's tax situation, their income situation, their savings, it's all different. So I don't know if I've ever really seen a standard graph that applies to everybody where that says, hey, at this age, this is where you need to make the switch from pre-tax to the Roth, right? Because I think it's going to depend on a number of different variables. I mean, I've seen times, there are a number of clients right now that I work with where, really from a tax standpoint, now I'm going to talk a little bit about Roth conversions here, not so much about putting money into a Roth 401k, but they are, they're converting some money from those pre-tax IRA accounts to their Roth IRAs now, even though it doesn't make the most sense for them from a tax standpoint for them right now. What they're doing is they are putting money in these tax-free buckets for their heirs and their future family. They're looking at it from more of a, like an estate planning, legacy planning tool, right?
Yeah. Well, and it can be for that distribution period as well. But if you have enough funds set aside, this could be a great tool because, with that 10-year rule now, your heirs may inherit funds while they're in their peak earnings years, and you want to make sure that, you keep as much money in the family as possible. So that can be a great tool. They still have to take required minimum distributions over the 10-year period, but they'll be tax-free. So
right.
Money goes much further. So there's no quote unquote line in the sand, so to speak, because you may have X amount of income now and be in this tax bracket. And then when you retire, you may be in a totally different place.
That's right.
But we also, here's the problem too. A lot of this is very hypothetical because we don't know exactly where taxes will be. I mean, I personally feel like taxes are going to be higher. You may not feel that way. And you may say, I am going to have a significantly reduced amount of income, so I'm going to retire in a much lower tax bracket. I'm not so concerned about taking these distributions and paying taxes later because I live way beneath my means. What I'm going to pull out of this account is very little. Now, we just don't always find that to be the case. So for one person, it may make a lot more sense than another, because of based on the income you currently have and then what your income looks like when you retire and what other assets do you have to pull from. So, so many moving parts and things to think about when we're talking about the Roth conversion aspect. And then you got to have that belief. I mean, I've talked to people who are like, whoa, I'm not comfortable doing that. Okay, understood. Or I don't think taxes are going up. Well, that's what you believe. If you think they're going to go down, you're probably the outcast or the outlier of the group. But if that's the case, then yeah, you're right. But so that's why I think that, even doing some is going to benefit you in the future. It's kind of like eating your spinach, right? Nobody likes to do it when they're doing it, but later down the road, you're like, all right, well, not so bad.
Depends what's on the spinach.
Yeah.
Plain spinach, not so much. You got to mix it up a little bit, something in there. Onions. Brent says onions. Ooh, that sounds good. Spinach and onions. Roth conversions. And black pepper. Who would have thought?
You going to say liver next? I mean,
no, I'm not going to go with liver.
No, it's good for you.
No. You eat liver?
I have.
Okay. Not on purpose. Yeah. Brent says not on purpose. Yeah.
Oh, come on. I know you get the Luby special. No?
That would scare me. I'm sure liver's delicious. I had, that was a staple in our house when I was a kid growing up. I remember liver. I've been there, done that.
Remember liver loaf?
Oh, yeah. Mm-hmm.
Yeah, that burned me out.
Is Luby still open?
Yeah.
Yeah. One of them somewhere?
249 at Spring Cypress in Houston. Yeah.
Go get the blue plate liver special there.
That's
Luann platter?
Yeah.
Not so bad.
Yeah.
Hey, guys, thank you for joining us. Iconoclast, I appreciate you still being here. We made it past 5. I'm so proud of you. Thanks, guys. Hey, we will be back. We're going to finish this conversation up here. John and I will this week. Thank you guys for joining. Hit the subscribe, the like button. We appreciate y'all. Have a good day.